Quality growth ETFs are one of the quickest ways to get rich in a hurry, and more importantly, to stay rich. Look, it's tempting to YOLO your life savings into the next single stock with positive speculation around it, or to swoop up the next promising cryptocurrency. Especially when you hear about the people that did it at the right time and hit it big. But it's like the recent GameStop craze. For every roaring kitty that made bank, there's many more people that jumped in on the hype train and lost a bunch of money. Every time we hear about someone going from rags to riches, the story doesn't mention the other 100 people that lost it all on a similar gamble. But it is wise to put in some controlled risk, especially when we're younger, to speed up the wealth building process. And that is where growth ETFs come into play. In this video, I will rank the top 5 growth ETFs to get you rich in a hurry without risking it all. But first, if you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. And before I dive into my list, please let me know what your favorite growth stocks or growth ETFs are down in the comments. I'm always open to new ideas. I don't have a specific criteria for this top 5 list, but here are the things that I do care about. Total returns over the last 3, 5, and especially 10 years. This is the most important metric at the end of the day because it's a direct reflection of how much wealth each ETF accumulated. And with total returns on low-cost passively managed ETFs, I always prefer as long of a time horizon as possible because it helps show how each ETF handles a variety of macroeconomic situations. And even with these all being low-cost, passively managed ETFs that take any human gut decisions out of them, we still can't strictly go off past performance when we're looking into the future. We need to make sure that the ETF makes sense moving forward. Another thing I care about is that the ETF is passively managed, and extra bonus points if it's based on a well-known index, such as the S&P 500 or the NASDAQ 100. Again, the more history the better, and it gives us a good idea of what happens in different situations with the economy. A low expense ratio is also very important to me. The true cost of expense ratios compound over the years, so they cost us investors a lot more money than what we literally pay for the nominal amount out of pocket each year. It's money that's not there compounding on whatever the growth assumptions are. Dividend yield and dividend growth rate are important even with a growth ETF. Dividend income will add up to boost the total returns alongside price appreciation. And lastly, a balanced holding and sector weighting is always a nice cherry on top. It's time to start building wealth. Let's dive into the list. 5th place, SCHG. SCHG is a well-known, solid growth ETF. It has $19 billion of assets under management and comes in at the 5 spot. Let's check it out. I've pulled up SCHG, the Schwab US Large Cap Growth ETF, on Seeking Alpha, which I find to be the best online resource by a mile for researching stocks and ETFs. It has an expense ratio of 0.04% or 4 basis points, and it's passively managed using a full replication technique to track the Dow Jones US Large Cap Growth Total Stock Market Index. Its holdings breakdown has 45% tech, so it's fairly tech heavy, anywhere from 12 to 13% of healthcare, communication, and consumer cyclical, and about 6% financials. The top 10 holdings make up 55% of the fund, and there are 254 total holdings. Taking a quick look at the dividend summary, its current dividend yield is 0.48%, and its 5-year growth rate is a dismal 0.82% and has 0 years of growth. Okay, now we get into the good stuff. Total returns. Now I've added VOO, which is the S&P 500 ETF from Vanguard, for reference, and I'll leave it here throughout the video. So year to date, SCHG is ahead of the market on returns, 31.5% to 13.6%. Over the last 1 year, SCHG is at 24.6% and the market's at 17.3%. Over the last 3 years, we have 28% SCHG and 34% market. Over the last 5 years, SCHG is up 82% to 60 of VU, and the 10-year zoom out shows 280% gains compared to the market's 205%. Fourth place, IWY. IWY is the least known ETF on this top 5 list. It only has $6.5 billion of assets under management at the time of this recording. Let's look at the details of this under the radar gem. IWY is the iShares Russell Top 200 Growth ETF. It has an expense ratio of 0.20%. The fund seeks to track the performance of the Russell Top 200 Growth Index. So it's passively managed just like the other funds in this top 5. It has a similar holdings breakdown to SCHG. It's about 45% technology. Consumer cyclical comes in at 16%. And then communications and healthcare are 12 and 10%. And it has a touch of financials, consumer defensive, and industrials as well. Its top 10 holdings are 59% of the fund, and it has 117 total holdings. IWY has a little better dividend than SCHG at a yield of 0.72%, a 5-year growth rate of about 3%, and 1 year of growing its dividends. IWY has a year-to-date total return of 29.4% compared to 31.5% of SCHG. It has a 1-year return about the same as SCHG, both around 24.5%. Its 3-year return is 30% compared to 28%. Again, they're both trailing the market a little bit during that time frame. Now its 5-year return is up to 88% compared to 82% of SCHG, and its 10-year return is 320% compared to 281%. Third place, QQQ. Invesco QQQ is the most popular ETF on this list by far. It has over $198 billion of assets under management. And to remain more competitive, Invesco QQQ actually made a new holding, symbol QQQM, in October of 2020. And this newer version already has over $14 billion of assets under management. Let's take a look under the hood to find out what makes QQQ so powerful. I've pulled up QQQ on Seeking Alpha, and QQQ has an expense ratio of 0.20% or 20 basis points, and it seeks to track the performance of the NASDAQ 100 index. The fund is passively managed, and I give it bonus points personally for following one of the major indexes. For the holdings breakdown, much like the others, it's tech heavy at 49%, and then communication and consumer cyclical comes in at 16% and 14%. Then it has a touch of healthcare, consumer defensive, and industrials as well. And it has 102 holdings, again, 100 of the largest companies from the NASDAQ Composite Index. And the top 10 holdings make up 48% of the overall holdings. On the dividend scorecard, it has a dividend yield of 0.61%, an impressive 5-year growth rate of 10.5%, and it's grown for 1 consecutive year. And on the total return metrics, year to date, QQQ is the king at 35% compared to 29 of IWY and SCHG's 31%. If you look over the last 1 year, QQQ is top dog at 28%. Over the last 3 years, it's neck and neck with IWY. Over the last 5 years, it's dominating at 98%. And over the last 10 years, it has a pretty sizable lead of 389% versus 320 and 280. So far, the rank 3, 4, and 5 is making perfect sense here. Second place, VGT. VGT has been my favorite growth ETF for many years now, and it truly pains me to admit that after some objective research, it came in as the runner-up. VGT has a touch over $50 billion of assets under management. Let me show you why I love this one so much. I've pulled up VGT, the Vanguard Information Technology ETF, on Seeking Alpha, and as you can see, the expense ratio is a little lower at 0.10% or 10 basis points. The fund is passively managed, and it seeks to track an information technology index that consists of small, medium, and large size technology companies. And for the part that scares many people away, the holdings breakdown is basically 100% technology. And over the years, this is what I like about VGT. I'm a huge believer in technology, not only in the past, but much more importantly, in the future. I don't think tech is going anywhere. Its top 10 holdings make up 59% of the overall fund, and it does have 324 holdings. It mixes in some small and mid-sized tech companies. And one thing that many investors either like or don't like is that it's very heavy in its top 2 holdings, and it's been like that for a very long time. My personal opinion is that I'm very comfortable having it be Apple and Microsoft that it's heavy in, and the passively managed index will automatically weight down if those companies start to fall. The total returns for those two have absolutely obliterated all these ETFs and the market over the last 10 years. VGT is a growth ETF that's a low-key, legit dividend payer. Although it has a low yield at 0.75%, the 5-year growth rate is an astounding 13.2%. Its dividend growth is 0 years, but over the last 5, much like QQQ, the dividends have gone up immensely. All right, it's time for those total returns. We're starting to build quite the roster here. So on year to date, VGT has a solid 31.4%, but it's trailing QQQ. On the 1-year return, VGT does have the lead on the field by just a little bit at 29%. Over the last 3 years, VGT is the only one so far that has outperformed the market of 34% with a return of 36.5%. Over the last 5 years, VGT starts to pull away with 113%. And over the last 10 years, VGT absolutely dominates the competition at 467%. First place and new champion, XLK. The king of growth ETFs is none other than VGT's older tech brother, XLK. These two funds have an 80% fund overlap, which explains why they both crushed the competition. However, XLK knocked out its pesky little brother to become the new champion in 2023. Let's take a look at where this upset knockout occurred. I pulled up the champion XLK on Seeking Alpha, and this is the Technology Select Sector Spider ETF. And just like VGT, the expense ratio is 0.10%. And just like the other ETFs, it's passively managed. It seeks to track the performance of the Technology Select Sector Index. And much like VGT, it is 100% technology here on its holdings. The top 10 holdings are identical of the top 10 of VGT. However, each one has a little more weight in it, and there's only 68 total holdings overall. The top 10 making up 70%. So these exact same companies in the same order just have a higher weight each. You have a little more of your eggs in these individual baskets compared to VGT. Its dividends are a touch higher at 0.87%, and its 5-year growth rate is a very solid 7.8%. All right, on to the most important metric by far and away, and that's the total return. How much wealth have these babies built for us over time? On year to date, XLK is 32.5%, which is ahead of all of them except for QQQ. Over the last 1 year, XLK is ahead of the field, including VGT by a little slice here. And this is where I began to lose my mind a little bit. Over the last 3 years, XLK is 44.4% to VGT's second place, 36.5%. A fairly sizable spread there. Over the last 5 years, 127.2% compared to 113%. And over the last 10 years, it also ekes out the win at 479 to 467. Now I'm still VGT, and I do like that it's spread over 300 plus companies, but it's getting more and more difficult to not put my dollars into XLK when it wins on every single stretch of time over the last 10 years. I'm thinking I might have to split some dollars here. Right now, VGT is the only one of these I officially own. I've been heavily considering QQQ for a long time, specifically QQQM, and now considering XLK, which for me came out of nowhere. I've known about the fund, but I did not know its return history was so good. Growth ETFs are fantastic ways to grow your wealth while mitigating risk over long stretches of time. And you can't go wrong if you pick any of the 5 from this list or a combination of them, as long as you dollar cost average in and stay the course. The power of these ETFs being a big basket of a whole bunch of different individual stocks is that it helps diversify and mitigate our risk over time compared to hand-picking specific growth companies, which can lead to disastrous outcomes. You'll want to throw in some quality dividend ETFs as you get closer to retirement to increase your cash flow and stabilize your portfolio. Check out this video right here to see the top 5 dividend ETFs to make your retirement a breeze. Thanks for watching, and I will see you here next Thursday. Peace be with you.